Hey everyone, welcome back to the channel. If you've ever felt anxious about the stock market, made a trade that you absolutely regret, or wondering, am I doing this completely wrong? You're not alone. And in today's video, we're going to be diving into one of the most overlooked topics when it comes to investing is the psychological aspect. Now we'll be talking about FOMO, panic selling, when in timing the market, does it actually work, and the mindset to build wealth in a long-term capacity. So let's go ahead and get into it. But when we start thinking about understanding really the investor psychology, it's not so much about the numbers, it's about the human behavior. For every decision that we make, it is influenced by our emotions. When the market's up, people are incredibly greedy. When the market is down, they panic sell. And this causes people to actually miss opportunities and they chase the hype. When you think about it, it is not just a theory. There is a behavioral finance that is actually behind this. It explains the psychological factors that impact the decision making that you do. And most of the time, these emotions lead us astray. This is the reason why I focus on separating the emotional aspect with the logical aspect. Now, one of the key principles for this is loss aversion. People don't want to lose money. If you're working a 9-to-5 job and you're generating income, that hard-earned money that you're investing, you do not want to lose money. It is the idea that the pain, and could be physical or emotional pain, of losing money in the stock market is twice as strong as the joy of gaining money in the stock market, which is the reason why loss aversion is so strong. And that is the reason why so many people do panic sell when we see downturns or make very impulsive moves when we see things like Bitcoin at $118,000 continue to go up. Now, recognizing this emotional cycle will really be the first step towards making smarter and more disciplined approach when it comes to investing. Now, one of the big ones that we always look at is FOMO, or the fear of missing out. FOMO is real. If you ever looked at the crypto market, it has been incredibly volatile, but it is also one of the biggest traps that investors can fall into at all. If you've been watching a stock like Nvidia and it's been going up for weeks, you see all of the social media buzz. You see everything saying that everyone is calling it out. We see it on YouTube. We see it on TikTok. You see it on Instagram. So what happens next? You rush in, you buy that stock, and all of a sudden you realize it was at your peak. You didn't do your research. It was based on what was on social media. And by the time you're in, early investors that already made those gains are cashing out, causing that price to dip. And then of course, you're left holding that bag and holding that stock when it is coming down. Now, this is the biggest danger of FOMO. It's emotional. It is not strategic. It does not have your best interest in mind. You're not thinking of the investing psychology or really the investing plan that you came up with before you ever started. To avoid this, have a watch list of companies. Know exactly how you're going to invest and what kind of investor you are. Always keep in mind what type of risk you're willing to take. Set price targets, stick to a plan. This is the biggest way to really overcome that emotional aspect that is tied with investing, is coming up with a plan on exactly how you're going to be investing and knowing that over an extended amount of time, talking 5+ years, just because something is trending doesn't mean it is a very good investment. Now, when we start thinking of panic selling or fear, when fear takes over, it can absolutely devastate a portfolio. When you flip a coin, panic selling is something you definitely don't want to focus on, or definitely something that you want to avoid. Now, this happens when we see a market crash, we see a market correction, log into the account, you see that it is red, you want to get out before it gets worse. Now, this is a survival instinct. Again, when it comes back to the behavioral, when it comes back to the psychology, it is really, it's a survival instinct, but it often leads to locking in the losses at the worst possible time. Let's go back to March of 2020. So we know this was when COVID happened. S&P 500 dropped 30% in a matter of weeks. Tons of people sold out. I got a lot of calls. I seen a lot of people, even on the YouTube channel, a lot of people cashed out, and we seen a full recovery and even record highs if they would have kept the money invested instead of selling at that 30% loss and then trying to find a way to get back into the market or time to get back into the market. They really locked in those losses. Now, the stock market traditionally is going to go up and down through history, and riding up the downs and riding the waves really is how the stock market looks. That's the reason why I say you need to go and look, because market dips are normal, but really pan out to about 3 to 5 years and see what the return looks like, whether it's a individual stock or an ETF. It happens regularly. And historically, the market has always recovered over an extended amount of time. Now, when we talk about panic selling, this locks in those losses. It turns your temporary losses or those short-term drops into permanent losses when you sell that. It is really building the habit of pausing before you react emotionally. Zoom out, look at the 5-year plan, and remember what those long-term goals are. Now, this is one of my favorite ones, Warren Buffett, time in the market versus timing the market. This is the absolute most important part of the entire video. Time in the market has always beat timing the market 99% of the time. When you start thinking about people that want to time the market, it's near impossible, even for professional investors who literally make a living doing this, to time the market and know when to get in, when to get out. Most people think that buying low and selling high is the only way, but it is also almost impossible to do this consistently. So here's a fact for you. According to JP Morgan Chase, if you miss just the 10 best days of the market over a 20-year span, your return would drop by 50%. Think about this. If you missed the 10 best days in the market over the last 20 years, your returns would drop by over 50%. That is absolutely crazy. A majority of the worst days, majority of the best days come after we've seen the worst days. And of course, this is also with when you start looking at years. 2022 was a definite rough time for the market, down around 20%. But then you fast forward looking at 2023, 24, and now going into 2025, we have seen a very, very big rally. I'm talking 20% plus within the S&P 500, which is kind of crazy. Now, this is why long-term consistent planning makes a big difference. Focusing on that dollar cost averaging, investing the same amount on regular intervals. For me, I do this every single Monday morning. We put money into the stock market. This strategy helps you build wealth a little bit slower, but it is much safer regardless of where that volatility is within the market itself. And the last one I'm going to leave you guys with is mastering your mindset. How do you build the mindset of a successful investor? It starts with automation. When we talk about dollar cost averaging, when you even think of a 401k plan, it is setting up automatic transfers for an investment account, knowing that the portfolio you have is built. You don't have to trade, you don't have to buy, you don't have to sell. It is about generating wealth through consistent and constant contributions, setting your goals. This is where I feel like a lot of investors are really missing out. Is it a goal to retire? Are you looking to buy a house? Is it 18 years for your kid's future? Have a purpose and really knowing what your focus is when it comes to investing over an extended amount of time, and also understanding that market volatility is normal. If you look on a day-to-day basis, even a week-to-week basis, you're going to have up weeks, you're going to have down weeks. You're going to have the news that is telling you there's tariffs, they're on, they're off. And I mean, even thinking the last 20 years, the kind of crazy headlines from the housing market crash to even 25 years ago, the dot-com bubble, to COVID that happened, the market has always come back. This is the reason when it comes to knowing my plan, limit how often you check your portfolio. For me, it might be every week, it might be every couple weeks that I look at the portfolio and know exactly where I am. For most long-term investors, that is what it is. When you think of investing as more of a marathon than a sprint, you'll see an incredible amount of success. Now, if this video really helped to rethink the framework when it comes to investing, hit that like button, subscribe to the channel for more content, drop a comment down below. What's one emotional investing mistake that you made and what did you really learn from it? And remember, you don't have to be perfect when it comes to investing. You just need to stay consistent with the goal. Thank you for watching, and I'll catch you in the next one.